$50 billion. That is the market cap of a company currently trading on the NASDAQ. They reported a record 300% growth last quarter. Wall Street calls them the future. Retail investors call them a financial revolution. But if you open their recent 10K filing, bypass the glossy graphics, scroll down to page 74, and look at the operating cash flow, you will see a negative sign, a negative $2.5 billion. They are bleeding cash at a rate of $10 million a day. They are, by all traditional metrics, technically insolvent. Yet their stock price hit an all-time high exactly 4 hours ago. Money cannot simply materialize from the void. Physics does not allow it. Economics does not allow it. So where is this liquidity coming from? It is coming from you. This is not a conspiracy. This is the architecture of modern market delusion. The original Enron used off-balance sheet special-purpose entities named after Star Wars characters to hide massive mountains of debt. That was the year 2001. That methodology is now obsolete. The next Enron does not hide its debt. It rebrands it. It parades its losses in broad daylight and convinces the market that losing money is a feature, not a bug. They call it aggressive market expansion. They call it capturing the ecosystem. But mostly, they hide behind a completely fabricated accounting metric called community-adjusted EBITDA. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. It was originally designed in the 1980s to evaluate the profitability of leveraged buyouts. Today, it has been weaponized. Tech companies add the word adjusted to exclude real, unavoidable expenses. They exclude stock-based compensation. They exclude litigation costs. They exclude restructuring fees. They strip away the cost of rent, the payroll of their engineers, and the marketing budget. If you take a company losing $3 billion a year and simply choose to ignore the $3 billion it costs to run the company, suddenly you have a highly profitable enterprise. You are not looking at a balance sheet. You are staring at a mathematical mirage engineered to deceive. But a mirage cannot sustain a $50 billion valuation alone. It requires accomplices. It requires the manufacturing of mass delusion. Enter the venture capital ecosystem. These early-stage funds buy into the startup when shares are priced at pennies. They hold massive illiquid positions. To realize their profits, they need an exit strategy. They need retail liquidity. They need the public market to buy their heavy bags. This is where the financial media apparatus is activated. Headlines begin to flash across terminals and social media feeds. Hypergrowth, disruptor, paradigm shift, generational wealth opportunity. The narrative is carefully constructed to trigger the most primitive human emotion in finance, the fear of missing out. FOMO is no longer just a psychological quirk. It is a weaponized algorithm. A teacher in Ohio puts her retirement pension into the stock because a teenager on TikTok told her it was the next Amazon. A mechanic in Texas takes out a second mortgage on his home to buy out-of-the-money call options. They do not read the 10Q quarterly reports. They do not calculate the weighted average cost of capital. They read the tweets. They look at the upward trajectory of the chart. They are no longer investing in a business model. They are participating in a synchronized global hallucination. To maintain this hallucination, the company must show relentless, exponential revenue growth. How do you fake revenue in the digital age without faking physical invoices? You use circular mechanics. The strategy is elegant in its deception. Let us say Company A creates a cloud software platform. The product is mediocre. Organic customer acquisition is stalling. So, Company A takes $50 million from its recently acquired venture funding and invests it into a struggling, obscure startup, Company B. 2 days later, Company B miraculously signs a $50 million enterprise software contract with Company A. The capital has just completed a perfect circle. It moved from the left pocket, through an intermediary, and right back into the right pocket. But on the next quarterly income statement, Company A just booked $50 million in pure high-margin software revenue. The auditors sign off because the cash actually changed hands. Wall Street analysts applaud the aggressive growth metric. The algorithmic trading bots detect the revenue beat and trigger massive buy orders. The stock surges another 15% in after-hours trading. The maneuver is perfectly legal under current loopholes, and it is mathematically terminal. Every financial cult requires a messiah to distract the followers from the math. The architect of the modern corporate fraud does not wear a tailored gray suit. He wears a plain black t-shirt. He speaks in cryptic buzzwords: artificial general intelligence, total decentralization, the democratization of finance. When he speaks, he does not discuss gross margins or the cost of goods sold. He discusses saving humanity. He positions himself not as a chief executive officer, but as a visionary fighting against a broken system. When a seasoned financial analyst from a legacy bank dares to point out the negative cash flow on a public earnings call, the CEO does not answer the question. He attacks the questioner. He mocks them as dinosaurs. He calls them short-sighted. He immediately opens his social media app and unleashes an army of retail investors to harass the analyst online. The stock price becomes a proxy for faith. Questioning the valuation, pointing out the glaring holes in the balance sheet, is no longer considered a standard financial disagreement. It is treated as heresy against the future. But absolute faith does not pay the server hosting bills. Look closely at the Form 4 filings hidden deep within the Securities and Exchange Commission database. While the CEO is tweeting about diamond hands, holding the line, and the limitless potential of their technology, his automated 10B 5-1 trading plan is quietly executing in the background, selling 100,000 shares every single Tuesday. The chief financial officer just offloaded 40% of his vested stock options. The early venture capital backers are liquidating their positions block by block, routing the trades through dark pools to avoid crashing the price. They are methodically stripping the copper wiring out of the walls. They are building private lifeboats while selling the public premium tickets to the Titanic. The illusion of infinite growth is ultimately destroyed by a single inescapable force: gravity. Mathematics is undefeated. The macroeconomic environment shifts. The Federal Reserve adjusts the federal funds rate by a mere 50 basis points. The era of zero interest rate policy dies. The spigot of free capital is violently shut off. Suddenly, corporate debt is catastrophically expensive. The company needs to roll over a $2 billion convertible bond to keep the lights on, but the credit markets have frozen. The institutional lenders demand actual yield. They demand physical cash flow. The company has none. The cash burn rate accelerates from 10 million a day to 15 million a day. The circular revenue tricks no longer work because the intermediary shadow startups are quietly filing for bankruptcy. The ecosystem collapses inward. The mechanical breakdown of a $50 billion empire does not begin with an explosion. It begins with a whisper. A Friday evening press release dropped at 4:55 p.m., engineered to avoid the daily news cycle. The company announces a routine delay in filing their 10K annual report. They cite an ongoing internal review of revenue recognition practices. The language is sterile. The implications are lethal. The following Monday, before the market opens, the chief financial officer resigns abruptly to spend more time with his family. The architects are abandoning the structure before the demolition charges detonate. Institutional algorithmic trading platforms instantly process these filings. They do not feel loyalty. They do not read the CEO's visionary tweets. They recognize the exact digital signature of a financial death spiral. Within milliseconds, high-frequency trading bots initiate massive cascading sell orders. The stock price plummets 20% in the first hour of trading. The retail investors, conditioned by years of market manipulation, rush in to buy the dip. They average down. They are fueled by the CEO's desperate social media posts, claiming this is a coordinated attack by short sellers. They believe they are fighting a righteous war against the establishment. It is not a war. It is a slaughter. The establishment has already exited the building. The following week, the prime brokerages issue margin calls. The company's collateral is worthless. The lender seize assets. The stock drops another 40%. Trading is halted multiple times due to extreme downside volatility. When the retail trading applications inevitably freeze the sell button to protect their own clearinghouse liquidity, the retail investors are trapped in a burning room with the exits welded shut. A $50 billion valuation is vaporized in 14 trading days. The retail capital is completely annihilated. How do you spot the next Enron before the collapse becomes public knowledge? You do not listen to the earnings calls. You perform an autopsy on the living host. You look for the mechanical anomalies. Here's the exact survival checklist. 3 mechanical indicators that signal an impending implosion. First, you isolate the day's sales outstanding metric. This is the exact number of days it takes a company to collect physical cash after booking a sale. If the top-line revenue is growing by 50% quarter over quarter, but the days sales outstanding suddenly spikes from 30 days to 90 days, they are booking phantom sales. They are utilizing channel stuffing. They are forcing inventory onto distributors who cannot sell it, recognizing the revenue immediately, and pretending the cash will arrive eventually. It never will. Second, you audit the related party transactions. You must dig into the microscopic footnotes of the financial statements, past the glossy ESG reports. If the company is constantly leasing commercial real estate from an unlisted holding company owned by the CEO's brother, or issuing massive uncollateralized loans to an obscure software vendor founded by former executives, you are not witnessing corporate synergy. You are looking at a highly sophisticated, perfectly legal embezzlement pipeline. The wealth is being extracted through the back door while the front door is painted gold. Third, and most importantly, you measure the absolute divergence between net income and operating cash flow. This is the ultimate lie detector in modern finance. If the income statement boasts a record-breaking net profit of $500 million, but the cash flow statement reveals the company burned $300 million in daily operations, the profit is an accounting fiction. Earnings are an opinion manipulated by accountants. Cash is a physical reality. When earnings and cash flow diverge exponentially, the collapse is imminent. When the dust settles and the bankruptcy is finalized, the theatrical fallout begins. Congressional hearings are televised. Politicians express rehearsed outrage. The regulators vow to tighten oversight. But you must understand the most terrifying truth of the financial system. The system did not fail. The system functioned exactly as it was designed to function. The Securities and Exchange Commission will eventually issue a meaningless $50 million fine, paid for by the remaining shareholder capital. 5 years after the executives have secured their offshore trusts. The Big Four auditing firms will testify under oath that they were deceived by management. They will claim no responsibility, despite signing their names on every single fabricated ledger. They are not paid millions of dollars to protect your retirement portfolio. They are paid to ensure the corporate fraud strictly complies with the generally accepted accounting principles. The architects of the collapse face zero criminal charges. They simply rebrand and launch a new venture capital fund. The retail investors lose their life savings. This cycle is not an accident. It is a feature of the market mechanics. The next Enron is not a theoretical concept. It is not a ghost from the year 2001. It is currently trading on the public markets. It has an exceptional corporate governance rating. It is being recommended by your favorite financial influencer right now. And mathematically speaking, there is a very high probability that it is sitting inside your passive index fund at this exact moment.